All right, so again, welcome to our final webinar of our winter series of financial literacy. Again, my name is Alta Simmons and I'm joined by...
Hi, my name is Noemi Bravo.
And we are excited to bring you this webinar on a very important topic, especially in the times we're living in right now. It is debt management. Before we get started, I would like to share a little bit about who we are, where we came from, our story. And that story starts many years ago. Originally, we were the Dallas Postal Credit Union, and in April of 1930, just months after the U.S. stock market had crashed, and during the Great Depression, when American confidence in financial institutions was at an all-time low, the Dallas Postal Credit Union won the trust and loyalty of its charter members. And in 2001, the credit union officially changed its name to Neighborhood Credit Union, which is a name we feel more accurately reflects a diverse base of members that we have from all over the Dallas area. In 2019, the Neighborhood Credit Union Foundation was established so that we can improve lives of consumers just like yourself in the state of Texas through promoting financial wellness, providing access to financial education, and raising the overall level of financial literacy. We focus on guidance, assistance, and support in all financial health initiatives for you and your family. So now let's get into this very exciting webinar. I love this topic. It's one of my very favorites, truth be told. And the goal for today's workshop are all focused on giving you a realistic perspective about debt, presenting you strategies for managing your own debt, and supporting you as you consider your next steps. So by the end of today's workshop, we hope that you will be able to attain the 4 goals that are listed on the slide. So I'll give you a moment to review them. And if you haven't had the chance to download the participant guide, please do so so you can follow along with us. So debt is something that millions of people deal with, and learning how to manage debt is one of the most important things a person can do to improve their financial health. Maybe paying off debt has prevented you from saving money and forced you to live paycheck to paycheck. It may also be possible that this debt has caused some tension in your home. You're not alone. In fact, according to one survey, nearly 75% of Americans are in debt right now, and most people owe an average of $38,000 in personal debt, and that's not even including their home mortgages. So being in debt causes us stress, and that can impact our relationships. Here are some alarming numbers. 21% of people say debt has caused household tension, and 31% say the debt has had an impact overall on their health. Maybe it's affected your health at one point. Plus, 15% of millennials say that they have held off on getting married just because, they're debt, and as well as having children. When you have high amounts of debt, we have trouble saving for retirement or even a down payment on a home, both of which help us plan for the future. This is the case for about 30% of millennials. And as you can see, the effects of debt can seep into many parts of our lives and can have serious and lasting impact. The only solution, debt management, and that's why we're here today. So before we get into a deeper discussion about managing debt, we need to explore what debt is. Debt includes the principal amount or the original amount borrowed plus any interest and fees. The interest is the amount we're being charged to borrow money. The interest is the percentage of the principal, usually charged annually. The interest percentage can vary depending on product or service, as well as your credit rating. For instance, in 2020, the average credit card interest rates were around 15% to 22%. That is really high, y'all. While car loan interest rates for fair credit, the average was about 7%. And if you have been a victim of these type of double-digit rates on your credit cards or even on a vehicle loan, please reach out to us after this webinar. Even if you've been denied in the past by us or another financial institution when it comes to an auto loan, talk to us. Our lowest qualifying rate is 2.69 right now, and if you have high interest rates on your credit cards, I was personally helped last year when I did a balance transfer to Neighborhood Credit Union and was able to get 0% interest for 6 months while I paid down that high interest or paid down that debt with that high interest I was getting at another financial institution. So please don't hesitate to ask us about that after this webinar, because we do want to help you manage that debt. And when you're researching loans, it is important to consider the interest rates that are being offered. A lower interest rate means you pay less in fees to a lender over the life of the loan. On the other hand, if you're investing money into perhaps a savings account, you're acting as the lender. And so therefore you want a higher interest rate. So that way you can earn more money on your investment. And who doesn't want to earn more money in a savings account, earning that interest? And we can also help you with savings accounts with our higher interest rates, us being a credit union. So definitely speak to us about that if you need help with those needs. And also, just a little bit more about interest rates, they can either be fixed, which means they stay the same during the life of your loan, or they can be variable, meaning they change according to the economy or even your credit agreement. A fixed interest rate is typically a safer bet than a variable interest rate because the amount you'll be charged over the life of the loan remains pretty much the same. And with a fixed interest rate, there won't be any surprises on how much you're going to owe. Now, there are very basic definitions of interest rates and not meant to guide your purchasing decisions alone, okay? What's important is understanding that when it comes to debt management, it's interest that can really get you into trouble. So I want to tell you a little story. And in our first example, we're going to talk about Ralph and his regrettable roof repair. So this may ring true to a lot of folks on this webinar who, you know, in North Texas, we have a lot of wind, a lot of hail, and, you know, especially going into March, we have hailstorms and there's always something happening with our roof, shingles blowing off and whatnot. So in this example, Ralph was in a particularly wet winter and his roof started leaking. So he called a roofing company who quoted him about $3,000 for the repairs. But Ralph had just purchased a new car because life happens, right? And then he's also paying his son's college tuition. He just didn't have enough cash on hand. And many of us may have been in that situation before. So unfortunately, he just could not wait. There was rain coming in the forecast for the weekend, and his mother-in-law was coming into town, so he definitely didn't want to have any issues there. So he did what most of us would do. He charged the repair to his credit card. So you might be thinking, okay, well, $3,000 really isn't that bad, especially if it's a hailstorm in Texas or, you know, but until you start factoring in those interest payments, that's when things get really tricky. How much did this $3,000 purchase end up costing Ralph? And how long did it take him to pay it off are the questions you want to ask. Well, if the APR, that is the credit card interest rate plus fees on Ralph's credit card, is about 17%, and if Ralph was only paying the minimum monthly payment of about $50 a month, it would take him 135 months to pay his debt. That's over 11 years. And by that time, especially if you live in Texas, Ralph would definitely need a brand new roof. And what's worse, Ralph will end up paying an extra $3,743 in interest for the credit card loan, meaning that when it's all said and done, the roof repair will have cost him nearly $7,000. So Ralph is definitely in debt. And this situation is not unusual. In fact, it's situations just like these that can contribute to many people's financial issues. Unexpected expenses, they come up all the time. And if you don't have any emergency savings, your options can be severely limited. And I want you to consider the fact that 18% of adult Americans who were hit with a medical bill just in 2019 in the amount of $1,000 to $1,999. So without emergency savings, they probably had to do what Ralph did, which was put it on their credit card to cover the cost, increasing their overall debt. And when these debts pile up, it can have a long-term impact on your financial stability. And I want to pause here to insert my story because I was one of those folks that was impacted in 2019 due to a medical bill. And my son, Elijah, swallowed a penny. And I always say that is the most expensive penny I've ever paid for. Because when it was all said and done, it was about $1,900 that we had to come out of pocket for his medical expenses just to make sure that his throat was clear and x-rays and things like that. So had we not had emergency savings at that time, we would have probably had to charge it on a credit card and got ourselves in deeper debt. So maybe you've had a similar experience in 2019, especially with COVID-19 coming into 2020. So being in debt can often lead to a downward spiral of financial burden and even more debt. And you see, debts affect your credit score. And I'm sure you can see that here on the slide. Your credit score is a number applied to your overall credit history. It's the number lenders use to determine how risky it is to give you a loan. So you could see the factors there that are figured into your credit score. So take a moment to jot them down if you need to, or snap a picture. And having a low credit score affects much more than just the ability to get a credit card. Your credit score is checked when you apply for a cell phone, rental property, utilities, and government programs. It may even be checked if you apply for a new job or for a car and home insurance. Some companies may refuse you services based on a low credit score, while other companies may offer services but with very high interest rates. Unfortunately, these higher interest rates just further contribute to a person's financial woes. Okay, so now we're going to go into our next example about Min and his friend Javier. They both purchased similar homes for about $300,000, which is pretty average here in the state of Texas, with a 20% down payment on a 30-year loan. However, Min's credit score was much lower than Javier's at the time. So his interest rate ended up being 1% higher. Min didn't mind, the 1% didn't seem to make a difference to him. But then Javier started to do the math for him. Javier showed Min how he'd be paying over $2,000 a year more in interest payments alone, and over $60,000 in interest over the entire lifetime of the loan. Now, you can refer to your participant's guide on page 3 for more information about calculating interest. Let's just briefly discuss the calculation for interest for today. And the equation that is used is I equals P times R times T. So the I is the interest, the P is the principal or the amount that you've borrowed, the R is the interest rate, and the T is the time, obviously, that it's going to take to pay it back. And as you can see, both your credit score and factors such as like market fluctuation can have a pretty serious effect on the interest rates banks offer you for a loan. In that scenario, Javier was able to put a lot more money towards savings and retirement because of his good credit. Men, on the other hand, just seemed to be accruing more debt trying to pay all his bills. Now, you can imagine Min was pretty upset when he found out how much more debt he would be accruing than Javier. But Min's mortgage debt should have been the least of his worries. You see, there are many types of debt, and not all debt is the same. All right, so earlier we posed a question about what is an example of a good debt. Pay careful attention in this next section so you can type your answer in the chat box. We're going to compare types of debt. And for many of you, your largest debt may be your mortgage. And for others, the largest may be your credit card debt. Mortgage debt and credit card debt are tied for the leading source of debt in America. Mortgage debt makes sense. Property is a huge purchase. But credit card debt, you know, where is all that money going? Well, according to our research, it's going towards entertainment, dining, nightlife. All of that amounts for about 15% of all credit card debt, following hobbies, passions, personal care, clothing, travel, and this may be the same for many of you. So debt that provides you with a financial advantage is sometimes referred to as good debt because the financial rewards you receive from the purchase counter the cost. Mortgage debt is often considered to be good debt because it's tax deductible and property has a tendency to appreciate or increase in value over time. However, if a property does not appreciate in value, or if the mortgage loan carries high interest rates, the mortgage debt can be a bad debt. Similarly, student loans are considered good debt because getting an education may increase your earning potential. However, if you take out a loan and never finish your degree, that debt becomes a bad debt. So the worst type of debt is the costliest debt. This usually comes from using credit cards with high interest rates to pay for things like dining and entertainment. And I think we've all been guilty of that. So when you don't have the money to pay it back, it's even worse. Some financial experts consider new cars to be a bad debt because they depreciate in value as soon as you drive them off the lot. Now, even though good debt can help you in the long run, it's still debt. And it's still money that needs to be paid back. Okay, so to determine a person's financial health, we will have to look at all debt, good and bad. One way that lenders and other experts may assess financial health is to look at something called the debt to income ratio, or DTI ratio. The DTI ratio is just what it sounds like, the ratio of a person's total debt to their income. So in order to calculate this ratio, you're going to add up all your monthly payments and divide that number by your monthly gross income, which is your income before expenses. And in our next example, let's calculate Adida's DTI. Adidas has a monthly gross income of $5,000, which is really good, and total debts of about $2,000. Not too bad. And using the DTI equation, it gives us a 0.4%. So Adidas' DTI ratio is 40%. According to financial experts, though, your DTI ratio should be lower than 40%, and below 37% is even better. If your DTI ratio is higher than you'd like, there are two main things that you can do. Number one, you could increase your monthly earnings, or number two, you can reduce your debt. We'd all like to make more money, of course, but most of us don't have any control over that. What do you do? What do you do to have some control over this money? Well, you have to manage it. And the first step, and the most important step in managing your debt, is, of course, managing your money, really. And what you have to do is you have to create a solid budget. So what I'm going to do is hand you all over to my coworker, Noemi, so she can get into talking about managing your debt and budgeting. So Noemi, please take it away.
Thank you so much, Alta. Okay, guys, so in this next section, we're going to go ahead and talk about some budgeting strategies. And if you need anything beyond budgeting strategies, we're going to talk about how to work with financial institutions to get you consolidation loans or anything else that is in budgeting. So first, let's go ahead and discuss budgeting. So financial gurus recommend that people create a budget following the 50-30-20 rule. And as you can see on the screen, 50% of your income should go to your needs or your necessary expenditures, like housing or food. 30% of your income should go to your wants. And this is going to be your fun stuff, like hobbies or dining out. And lastly, 20% of your income should go towards saving and debt payments. So if you have your participants guide on hand, we actually provided on pages 6 and 7 an opportunity for you to start creating your budget. So you want to list out your needs and your wants and then add them all up. So let's go back to Adida's example. Adida's monthly income after taxes is $5,000. If we divide his total needs of $3,750 from his income, we can see that he's spending 75% of his income in this area. And he's spending 20% of his income on wants. So if you don't have 20% remaining, you're not alone. Adidas certainly doesn't. If we look at his wants and needs, he has only 5% remaining of his income for him to put into savings and paying off debt. But 20% is your goal. This is the place that you want to get to. If you're not there yet, we're going to discuss debt management strategies next. But first, let's talk about how to use the 20%, because when it comes to paying off your debts, there are a few best practices. Financial experts recommend that any extra funds be applied to the following accounts on the screen in the following order. First, if you have your 20% left over, the most important thing would be to start creating an emergency fund. And nowadays, as we can see, that would be so important because as we can see, there's a lot of things that can happen that are unexpected. And having that emergency fund with 3 to 6 months of living expenses can be so important. Next, you can start maximizing your 401k employer match. After that, you can start focusing on paying off your high interest and high APR debt. So, most of the time that's going to mean your credit cards or your personal loans. After that, you can contribute 15% of your gross income to retirement. And lastly, if you are able to get all of this done, then you can start paying off your lower interest rates, which may be maybe car loans, normally have a lower interest rate depending on what your situation is, or your mortgage. You can see from these recommendations how being able to apply 20% of your income to savings and debt payments may benefit you financially. If you didn't have 20% left over when you calculated your expenses, let's talk about some other ways you can free up needed funds so that you can increase your debt payments and begin saving for the future. The first step in freeing up funds is cutting your own expenses. And I know that can sound easy, but it's actually really difficult. Most of us feel like we're living paycheck to paycheck as it is. And even though cutting expenses is not something any of us want to do, it's worth it in the long run. So let's think about ways that we can reduce our monthly expenses. And you want to start by trying to reduce your expenses in your wants category. Okay, so this would be, like I said, maybe your fun stuff, especially dining out. Can you reduce expenses in that area, or not spend too much money in shopping for personal items? Now, next, you may want to start looking at your needs section. For example, maybe you can make cuts to your grocery or your cell phone bill. So once you have a working budget in place and you figure out ways to free up funds to apply debt repayment and savings, you can begin creating a strategy to pay off your debts. Financial experts often recommend 2 strategies for paying off debt as quickly as possible. And these are known as the avalanche method and the snowball method. So let's talk about the avalanche method first. This method focuses on paying off the debts that have the highest interest rate first, while paying the minimum payments on the rest of your debts. So the theory here is that high interest rate debt will end up costing you more in the long run. So it's good to pay these debts off as quickly as possible. Okay, so taking this method, the avalanche method, which out of these 3 credit cards would you focus on paying off first? And you can chat your answer in the chat box. Yes, so Alexia and Cynthia say major credit card, and yes, that's correct. The avalanche method focuses on paying off the high interest debt first. So you would want to do the major credit card first. After that's all said and done, then move on to the next highest interest rate credit card, which would be the store credit card. Okay, so that's actually the method that I prefer, but sometimes that doesn't work for some people. I know some people that would actually prefer this snowball method. And the snowball method focuses on paying off debt with the lowest balances first, while paying the minimum amount due on the rest of your debts. And the thinking behind this is that you can pay off lower balances more quickly than higher balances. And paying off these loans will reduce your debt to available credit ratio. And it gives you a sense of accomplishment. Okay, so now we're going to do the same activity, but we're going to do it using the snowball method. So using the snowball method, which again, it means to paying off the debt with the lowest balance first, which one would you pay off first? Okay. Yes. Thank you, Alexia and Ramona and Maria. The first one, using the snowball method, would be the store credit card. And after that, you can focus on paying off your personal loan. So in paying off your debts, it's kind of like a personal preference. I do know that my boyfriend likes to get done paying off the smallest balance first, and he gets so happy when he's done with it, and then moves on to the next smallest, and he can just he feels a sense of accomplishment doing that. So it's just whatever method works for you. But what happens if budgeting and strategizing just isn't enough? Sometimes, no matter how we work the numbers, no matter how much we cut from our expenses, or how many additional jobs we take, it's still not enough. So in this next section, we'll cover additional strategies for getting control of your debt if you need something beyond budgeting. So these strategies will require you to communicate with lenders and seek outside assistance. Before we talk about what to do to manage your debt beyond budgeting, let's talk about what to avoid. So the first rule is avoid just closing out all of your credit card accounts. Canceling your credit cards may actually hurt your credit score. If you don't want to be tempted to use your credit cards, you want to put them in a safe or someplace that's inaccessible to you. Secondly, avoid borrowing from your retirement plan. I mean, first of all, you work so hard to save up for your retirement. And also, if you take money out of your retirement account now, you'll be hit with some extra taxes at tax time. And thirdly, be careful with those debt settlement companies. There have been many cases of debt settlement companies charging customers without delivering on their promises and providing bad financial advice. Experts warn to never pay fees for debt settlement upfront. And finally, don't hide from your creditors. It may be possible to make a deal with your creditors on what you owe. Talking to creditors is actually number one on the do's. So try requesting a lower monthly minimum payment or even a lower interest rate. If you're having trouble paying your bills on time, you may even request a deferment. A deferment postpones your debt payment for a limited time, allowing you to get your finances in order. You may also try credit counseling. And I would love to tell you about our nonprofit partner, which is GreenPath. And GreenPath, like I said, is a nonprofit organization that we work with at Neighborhood Credit Union, and we refer to all of our members. And they assist people with budgeting and debt management. And they can provide you with educational materials and help you create a budget or a debt management plan, and may even negotiate with creditors on your behalf. And the first counseling is free. So if you have any questions about, getting in contact with GreenPath, our nonprofit partner, send us a chat or let us know. We'll also post their website on the chat. Finally, there's debt consolidation. And this is where Neighborhood Credit Union can be such a big help for many people, because debt consolidation involves talking to your lender or Neighborhood Credit Union and get a competitive interest rate or lower interest rate than what you're currently paying. So your smaller loans, all those credit cards or all those personal loans that you have payments on, you can transfer it to a new loan with a lower interest rate, and it can reduce both the amount you have to pay each month and the total number of bills you have to worry about. And this option is helpful in managing monthly payments and paying off debt in a timely manner. So let's look at Carmen's example. You can see how debt consolidation was a good solution for Carmen. So through her credit union, Carmen was able to get her debt consolidated into a loan with a lower interest rate. And it freed her from stress of managing just multiple payments. So if you're in a similar situation, which is very common for people to be in, trust me, with those high interest credit cards, Neighborhood Credit Union can definitely help you with a consolidation loan. We will transfer all those balances to a lower interest loan, and it would just benefit you so much because, like I said, you would get lower monthly payments, and you can actually finish paying off this debt even quicker than you would. So what happens if you've just gotten into just a serious financial situation that can be handled with debt management strategies described earlier? Well, unfortunately, this is the case for many Americans. About 35% of adults with a credit history have debt in collections, owing an average of over $5,000. And in 2019, there were more than 774,000 bankruptcy filings. So in this last section, we'll talk about what to do if you have debt collections or if you're considering bankruptcy. When debt payments are past due and you haven't paid your bills for some time, your account is transferred to collections. When your debts go to collections, it can be emotionally draining. The debt will remain on your credit report for 7 years, and collectors may sue you, leading to wage garnishments, liens on your property, repossession, or even foreclosure. It's important for you to know your rights in this situation. The Fair Debt Collection Practices Act protects consumers from harassment from debt collectors. And according to the FDCPA, debt collectors may not call you before 8 a.m. or after 9 p.m. And they may not harass you or abuse you or threaten you. And they can only talk to you or your spouse about your debts. So if you think that a debt collector is violating this law, you can file a complaint with the Consumer Financial Protection Bureau or your state attorney general. So let's talk about just in the case that you're at a point that you're considering bankruptcy. There are 3 types of bankruptcy that individuals can file for debt discharge. Chapter 7 and Chapter 13 are the most common. For Chapter 7 bankruptcy, you generally have to prove that you do not earn enough income to pay off your debts. Chapter 7 may be an option for people who do not have a lot of liquidable assets or property, as these could be used to pay off some creditors. Chapter 13 bankruptcy is an option for people who generally earn a reliable source of income and can make a plan to pay off debts within 3 to 5 years. Bankruptcy is serious because it remains on your credit report for up to 10 years. So if you are considering filing for bankruptcy, it may be helpful to talk to a consumer or bankruptcy attorney so that you understand all your options. So whether you're considering bankruptcy or just need to work on your budgeting skills, you're already ahead of the game just by being here today. Many experts think that so many Americans are having trouble with debt and financial instability because we have poor financial literacy. Nearly 66% of Americans couldn't pass a financial literacy test in 2018. So after taking part of this workshop, hopefully you are armed with more information than most of Americans. All right, so we are nearing the end of our workshop, and let's just close it out with this last example. If you are following along with your participants guide, you can turn to page 11. Okay, so Emily is a project manager at a computer company. She makes a decent living, but she can't seem to get ahead of her financial bills. In fact, her finances just seem to be getting worse, even though she has steady income. So, what could Emily do budget-wise to help out her situation? She could look at other ways that she could save money. She could find a more affordable housing. She could also get a more affordable cell phone bill or cell phone plan. She could also reduce gas by carpooling. So there's just some ideas. Um, but if she wants to look at other debt management strategies, like we discussed, she could look into consolidating her credit cards. She could also consolidate her student loans, or if she has a car payment with a high interest rate, she can also look into refinancing that car payment. Okay, so we have actually reached the end of our workshop. After this workshop, hopefully you have the critical knowledge and skills of that elite group of Americans who can call themselves financially healthy. You'll also have the freedom to do what your debt is preventing you from doing right now, which is making your dreams come true. So remember to work on your personal budget. If you were not able to print your participant's guide ahead of time, don't worry, you can still log in to the webinar website and you can still print it. And at this point, we're going to go ahead and end the recording.